Last week we noted how President Trump had blamed the Federal Reserve for the US equity sell-off, claiming that it was raising interest rates too quickly. This week the turbulence continued, the S&P 500 falling to lows since May before rebounding off the lows on Tuesday. The President kept his eye on the stock market, deeming the October sell-off, quote, a little pause, and switching blame to the Democrats. This reinforced the view that Tuesday's US midterm elections are important for markets. In these elections, all House of Representatives seats are up for election, but only 35 of the 100 Senate seats. Political site 538 places around an 85% chance of the Republicans keeping the Senate and the same chance that they lose the House, which they have held since 2010. This would mean Democrats would set the policy agenda on a wide range of issues and take control of committees with sweeping powers. History suggests that while the economy is strong, President Trump's approval rating implies that Democrats have a strong chance of taking the 23 seats they need for control. Some high-profile equity fund managers have expressed concern that a Democrat House will find little common policy ground with a Republican Senate and White House, and therefore be bad for stocks. This makes some sense. At the very least, there would be no prospect of the tax cuts President Trump has been promising. Talk of impeachment would also hit the headlines. Yet polling has been pointing to a Democrat House for months, so perhaps it is all factored in. And the Fed is very unlikely to be swayed from a December rate hike even if stocks tank after the elections, given the tight job market, GDP growth running at 3% and inflation already at the Fed's 2% target. Still, there will be plenty of tension as the results are released during Sydney Trade Wednesday, with markets likely to react strongly whatever the outcome, just not as dramatically as they did 2 years ago. The midterms will be the highlight of the US calendar, overshadowing the FOMC meeting, which should result in steady policy and only a short statement. The Australian dollar was quiet for most of the week, but rallied steeply on Thursday to 72 cents, a 4-week high. Some of this rally was driven by broad US dollar weakness, but there was also some good news helping the Aussie. Australia's international trade report for September revealed not only a $3 billion trade surplus, but positive revisions. This official data supports the optimistic story on Australia's commodity exports that we have been pointing out for some time, even as the Aussie has struggled. While iron ore and coal remain Australia's top 2 exports, liquefied natural gas exports are accelerating rapidly. This strong performance suggests that the worst fears over the US-China trade war are not being realised. This may be at least in part due to China's reported focus on supporting growth through infrastructure spending, underpinning its demand for imported commodities. In the week ahead, the RBA meeting on Tuesday shouldn't provide much distraction from the Melbourne Cup, though its quarterly statement on monetary policy on Friday will be watched as always. Australia's data calendar is quiet. It is a big week for the New Zealand dollar, with the RBNZ meeting on Thursday including quarterly forecasts and maybe a reduced threat of a rate cut. The Kiwi is the only major currency stronger than the Aussie over the past week. But overall, whether the Aussie can continue its recovery to 73 cents is likely to be driven by the US election results, which means a very nervous Wednesday. We'll discuss the results next week.